Para o painel Crédito estruturado, aonde estão os blind spots e como se posicionar, convido ao palco Jéssica Leoncini, Head de Renda Fixa da gestora americana Janus Henderson, Marcelo Fiorellini, sócio da BTG Pactual Asset Management, e para a moderação, Graziela Auada, sócia do BTG Pactual.
Good morning for everybody. So we're going to start here our section about the structured credit. So thank you very much, Jennifer and Marcelo, for being here with us. And my first question would be for you both. For many investors, structured credit has been evolved from a niche allocation to a strategic one. In Brazil, it was certain the case as credit market grew substantially in recent years. Conceptually, how the role of the structured credit play in a diversified portfolio today, and how can improve it from a risk-return profile?
Yeah, I think it's definitely true that we've seen structured credit move from more of a niche allocation to something strategic, but there's still a lot of opportunity there. So we've seen asset classes like agency mortgages that tend to be big allocations within the benchmarks, like the Barclays US Ag, the Global Ag, and that's been a key part of investor portfolios for quite some time. But there's a lot of other areas within structured credit that can provide a lot of good diversification. And I think to provide a little bit of context, there's a big difference, and we heard a little bit on the last panel from Brad, there's a big difference between some of the public market dynamics and the private market dynamics. So when I'm thinking about more of the public securitized markets, that's a 15 trillion USD market. So very, very large, very, very liquid. And there's areas of this market that can provide uncorrelated returns that can actually increase the quality of a portfolio. So I think very important to differentiate public-private and start to look at some of those asset classes that can really provide diversification. One that we look at a lot is collateralized loan obligations, or CLOs. This is something that I think has been misunderstood for quite some time, but is an asset class that is over $1 trillion USD, has been used for decades by investors like large Japanese institutions, Japanese banks, large US insurance companies. So there's definitely a deep investing base in asset classes like this. And I think a lot of investors could benefit from some of the AAA rated assets within this asset class and some of the uncorrelated returns that you're able to get with some pretty attractive yields. So I think there's a lot of nuance to the asset class and certainly a lot of misunderstandings that hopefully we'll get to unpack a little bit here today.
Well, and establishing the parallel with Brazil also, I think private credit moved from something that was a niche market into a more strategic, undoubtedly. If you take, for instance, the $2 trillion market, which is now probably the private credit market in US, it accounts for 80% of the whole banking transaction moving to capital markets somehow. If you compare that to Brazil, 80% of the whole transactions is made by banks. So it's a huge concentration in the balance sheet. So we are in the beginning of that cycle yet here in Brazil. And when you look to the spreads that you can grant it from those structures and the way that those structures are more ring-fenced in the sense of having a tailwind or a black swan event and etc., I think the market has become more acquainted to have this kind of assets at the portfolio. Moreover, CDI is an asset class in Brazil. In order to beat the benchmark, you have to have exposure to credit. So undoubtedly, what we see, it's a big move into the market, and the flow is moving from the banks to the asset managements nowadays. We are talking about probably $1 trillion $1 trillion total banking lending now in Brazil, and just 20% that do it through the private market at the capital markets asset management.
We are supposed here to talk about the blind spot, right? So Marcelo, given the growth that you have just described, how much of it was fueled by preferential taxes, treatments of CRIs, CRAs, and in the case of the FIDICs, the tax deferrals? And do you think in the marketplace put tax treatment before good asset selection?
Well, it's a very good question. I think the straight answer is a lot. Tax benefit helped it a lot to grow in the market. And when I mean a lot, I mean a lot. There's no data consolidated under those issuances. Basically, the ABS structures through retail persons that have the tax break, but it's around R$1 trillion market right now. I think that the main question here is that tax breaks doesn't mean avoidance of credit risk. I mean, when a company goes and make issuance of a flat CDI instead paying a CDI plus a premium to the market, you're basically splitting the bill with the taxpayer of this tax exemption. But are we really being rewarded for the risk that we are taking? And this, I think, is the main question that we should look into those structures that flowed the market recently. And so I think was a good mechanism to make the start of moving the credit from bank's balance sheet into the capital market, attracting investors with the tax exemption. But the depth of the question in terms of how it has been priced, I think, is the key one. And I think and under those very volatile markets with some credit events, then can be dangerous.
Jessica, do you have any comments on the US and the BDCs?
Yeah, I think this has been relevant globally as well. So we've certainly seen this with the BDCs, or the business development companies, where we've seen a lot of money flow into this space. Now we're just starting to see come to light some of the concerns that maybe there isn't as much liquidity as investors thought. And that's probably one of the blind spots, the misconceptions, because this was never designed to be one of those areas of the market that is where you would go for your liquidity. So I think there's definitely an important need to kind of differentiate that, but we have seen a lot of interest in that space for the supposed promise of high returns, preferential tax treatment, and I think this asset class was largely sold on the notion of low volatility, which was really just an outcome of the asset class not being marked on a daily basis in a lot of cases. So now investors are seeing some of the gates of redemptions, which is designed for investor protection. But I think that raises a really important point to understand what the liquid components of your portfolio are, where to go in times of stress, and what those components of the portfolio are really designed for. So I think when you're looking at some of the stresses in the BDC market as well, the big concern with the market is there's about a concentration of 25% software within the BDCs. Now, that sounds like a big, scary number, and it could be, but I also think that the market is not doing a great job of differentiating across software companies, right? Not every software company is going to go bankrupt tomorrow. We still have a lot of very large, entrenched, important software companies that are doing the right things in terms of AI and will be here for the long term. It's also important to differentiate between different markets and what that software exposure looks like. So while you have 25% software in BDCs, in private credit, you only have 20%. In more public CLOs, you only have 15%. In the public high yield and corporate markets, you only have 2 to 3%. So your exposure is very different across the board. And I think this blind spot has been better understanding liquidity in the different components of your portfolio, better understanding the underlying investments and how those might complement each other or act in periods of stress.
Where do you currently see the biggest blind spots in the structure markets? And as we just talked about the BDC, it's good that you have already introduced here. Maybe they are a blind spot, but not they are visible, right? So do you think the BDCs can create market-wide credit crisis, or it's self-contained correction?
Yeah, I think it'll be more self-contained. So we've seen some of these industry-specific sell-offs over time. We saw the same thing in 2015 with the energy and oil industry. So when you have the return of the cost of capital, right? Remember, rates in developed markets have been extremely low for quite some time. We were at zero rates in the US for quite some time. That makes an easy environment for lending, for refinancing. And when rates started to go up in 2022, we saw that differentiate between companies where you had good, solid companies able to refinance, able to continue to deliver what their customers needed, and more stressed companies that really weren't able to survive in such an environment. So I think what we're seeing today is largely idiosyncratic, right? We've certainly seen some isolated indications of fraud from certain companies that is typically impossible to predict or to find ahead of time, unfortunately. But we're seeing some of these instances where every software company is being treated the same. Even when you've had software companies actually upgraded by the major ratings agencies, you've still seen price pressure on them. So I think that's a risk that is no longer a blind spot. I think that's very much come to life. But in terms of blind spots, I think there's also investors missing out on a lot of opportunity, right? Thinking of things like the BDCs and private credit and having that fear shadow other asset classes, where all of these asset classes are very nuanced and don't all act the same, don't all have the same liquidity, don't all have that same concentration. So I think part of that blind spot that I would look at is really that opportunity cost and missing out on some really important diversifying asset classes.
Can you comment a little bit on the Brazil side on this matter?
Oh, okay. Well, I think the nature between, well, if we take, for instance, from where this market started, start from the traditional banking sector. There's a huge difference between, I think, the essence of the relationship between companies and that demand credit from banking standpoint to investor asset management basis standpoint. And I'll explain that to you. Basically, when we have like a mutual bank doing credit, you have multiple layers of relationship with the company, which means from FX trading, from my investment banking, from private side, from commercial banking traditions, and etc. When you move that to a more, I'll say, the asset management perspective, which is more capital allocated driven, more relationship driven kind of relationship, despite the fact that you go tactical in terms of granting the right spread instead of building up a relationship, you're also lacking in terms of some credit infrastructure. And I mean credit infrastructure, not only systems, but I mean the whole systematic way that the bank organizes, the way that deliver credit, and the way that they follow up with the company. I mean, a company that have an exposure with a fund that see the low likelihood of being renewed, that credit facility is probably keen to take a decision instead of not being, I'll say, helpful to repay the debt, instead of a bank that will maybe give a hand when the company needed it because they have other kind of interest behind it. So I think the market is kind of navigating towards this understanding also in US as well. And this is something that is happening in Brazil. We see a lot of companies that if you take a balance sheet of a company 10 years ago, you probably will look at it and you see 10, 15 banks. Now it's easy to see a market insurance to the market, holded by several hundreds of funds instead of one single lender. And this changed the dynamics in terms of the renewal of the credit, which can accelerate it a lot. So this dynamic is something that I think the Brazilian capital market is getting acquainted. And the US, when you couple that with the flows, which were enormous during the last, let's say, half a decade, you get the pressure for it being deployed. You have the pressure for lending the money. And credit, it's something that has unlimited market. The demand is unlimited. Everybody wants credit and everybody demands credit. So it's and the way that you structure and having the right infrastructure to deploy the credit, I think, is the main point. And so establishing the parallel, I think, we're seeing in the U.S. market right now with the banks suffering and the funds suffering with the gates and the regards, I think it's more attached to the dynamics of the relationship with it. The great news for us is basically, since we're in the start of this cycle, we are learning from our big brother in the way that the market is developing and trying to deploy that in the local market. That's my takes for the Brazilian credit.
Let's try to tie the discussion back to the liquidity here. When comparing the US CLO market with Brazil's structured credit universe, liquidity is a key difference that investors should understand. How can you both comment that? Can start.
Yeah, I think what we're seeing in US markets, in particular in the CLO markets, is it's actually one of the most liquid asset classes in the world. So when we think of the greatest liquidity across fixed income markets, we think of US Treasuries and some sovereign bonds. We think of things like agency mortgages. Those are two of the largest asset classes globally, so have a lot of liquidity, a lot of trading on a regular basis. But what a lot of investors don't realize is, especially in AAA CLOs, they are actually one of the most liquid asset classes. And you see that in times of distress, right? And that's when everybody wants liquidity. You don't care about liquidity when things are good. You care about liquidity during periods of stress. So whether it was COVID in 2020, the UK pension crisis, the Russia-Ukraine crisis, the tariff-related volatility last year, some of the software-related volatility this year, AAA CLOs have actually had higher trading volume historically in every one of those periods. We continue to set new highs in trading volume. And that's a result of being backed by very large institutional investors within this space. Right, we've seen very large institutions continue to trade in this space and continue to demand very high quality assets in these periods of stress, but also the addition of ETFs within the space. So we manage the largest ETF within the CLO market. We've continued to see liquidity expand as a result, and that's something that I think is really important in those periods of distress. I know there are very attractive local rates. My understanding is the Fijiks don't have quite that level of liquidity. So I think some really interesting pair opportunities to better diversify an overall portfolio and have these types of allocations that will perform differently. What we also see that is on the back of all of this liquidity is the low correlation to traditional assets. So AAA CLOs, for example, have virtually no correlation to traditional fixed income, no correlation to equities. So when you're thinking about some of those asset classes that have disappointed historically, of being able to provide that diversification in down markets, right? 2022 equities and fixed income moved together. We're seeing that to some degree this year with the interest rate volatility. Really interesting to consider an asset class that has demonstrated that consistent lack of correlation and has been positive in times like 2022, positive so far this year. But I think really important to think about how those work together.
Well, here in the tropics, I think liquidity is not something that, well, moving to this structure, right? I think you nail it. It's basically, I like to compare liquidity, not binary. Liquidity is basically more related to air, liquidity, humidity. You have some moisture in the air sometimes. But going into that direction here, what we see when we go to some corporate doing some issuance that they provide with that asset-backed securities receivables from certain companies, you can find some liquidity because the company is probably listed. There's public financial statements of those companies, and there's an equity research regarding this, so you can follow it and maybe you'll find liquidity on it. But when you move to some really collateralized consumer kind of credit that would package into a FDIC, which is our ABS structure that can really, you need to behave there. There's no liquidity. So the best way to play it is don't count on liquidity and don't commit the original sin, which is mismatch between asset liability. That I think is the key point in here. In addition to that, also, I think like granted high spreads under the originations process by tailor-making and doing the whole transactions is somehow how we do it. The way that we play it is that since the market is in development, we usually would like to deploy our own capital alongside with our investors in the structure. So this gives the sense that we are understanding and have the same symmetry and there's risk. But I think definitely this is a very blind spot. The liquidity can disappear in the moments that you most needed it.
And I think we're talking a lot about liquidity, but it's important to also highlight that not everything in your portfolio needs to be liquid, right? It should match your overall goals. If your goal is a nice retirement, a nice university for your children, you don't need that money tomorrow. So you can capture some of that illiquidity premium in some assets, as long as you have the right amount of assets that do have that liquidity should you need it.
Structured credit should be considered a very selection-driven asset class. Hiring a good manager is a key factor because individual securities are very different, each structure is unique, and acceleration clause can vary widely. Can you comment on that?
Yeah, I think that's very important. I think as we talked about, some of the asset classes have their own nuances. Every structure does as well. So it's very important to understand an individual issue, the sponsor, the issuer, all of the documentation behind it. There's a lot of research that goes into making sure you're finding the right securities and making sure you have that diversification as well. I think we've seen this a lot in the corporate credit markets, which is typically a lot more familiar for most investors, where spreads have been extremely tight, right? We are back off a little bit this year with some of the volatility that we've seen, but still within historic tights over the past 10 years. That doesn't mean there's not still opportunity within corporate credit, but that probably means you need to be selective, maybe be cautious on the massive amount of supply coming to market with all of the debt issuance the hyperscalers are bringing to be able to fund AI. I think that selectivity is really important, but also translates to the securitized markets. The benefit, I think, within securitized is in corporate credit, you essentially find the company that you like and you assume their credit risk, right? If you like a company that's single A rated, triple B rated, you buy that company, you get that credit risk. Within the securitized markets, the way that the securities are tranched, you get to pick your level of risk. You get to say, I want to be the first one paid here. I want to make sure that I am in the safest tranche, that whatever goes wrong, I am very well protected. Or you can say, no, I'm super comfortable with this. I want to go down in quality. I want to get that higher yield, and I'm comfortable taking a little bit more volatility. So you have a lot of layers to be able to evaluate within the securitized market, looking across the different sectors from CLOs to asset-backed securities to commercial mortgages to all of those areas that could add value to a portfolio. But then once you find that issue that you like, where do you want to buy that? What credit quality are you comfortable with, and what volatility or return profile really matches your goals? So I think a strong selection process can help avoid some of those tail risks, right? We've heard a lot today about all of the uncertainty, and there's no shortage of headlines on any day that you wake up and open the news. So I think being very careful in what you are buying, but just as careful of what you're avoiding and what you're saying doesn't make sense for a portfolio will be the key to success for investors this year and going forward.
Would you like to comment a little bit on that?
Well, I like to compare. Usually when we go like liquid markets, and we are talking about our analysts and associate at the area, I usually compare that the alpha doesn't come from the trading or the market momentum from the way the business that we do. We like to compare that to more like a rocket launch or a satellite launch, which is basically you plan a lot, you build up the structure in the way that what can go wrong, what can go right, what can be the redundancy that you need to establish in your structure in order to accelerate the credit in the proper way that you get out firstly. So because when it's go in orbit, the likelihood of changing course is very low. So in a structure that you have like million of transactions going on, like a consumer credit portfolio, you really need to have this kind of handling. So it's much more planning, and the way that we frame that into BTG Pactual Asset in the structured credit world is basically we want to really have the driving seat of our transactions. We really do from everything from the structuring, from managing the risk, for controlling the risk. And this is, I think, is the key point into, in spite of buying tranches of that structure by third parties and etc. It can happen, but we are more verticalized in this sense to do it. So, and I think that's the way that at least protected us in the last few black slashes. One comment, in Brazil, we saw a really huge shift from mutual manager credit funds, which usually used to have 5 to 10% of their portfolio on credits in order to deliver some alpha. And those credits are basically corporate credits, AAA at the moment. I'll sell some names like Light and Lojas Americanas, which suffer a very black swan. And we are seeing a switching between those mutual fund investors preferring to be at ABS structures, CLOs, instead of moving into those spreads in those corporates, because the FDIC from Light, for instance, the ABS from this company that went bankrupt, performed quite well during the crisis. So the mechanisms of getting out automatically from the structure really helps a lot. And so this is one of the key drivers of the growth that this market is enjoying the last few years. I think the credit events in the corporate credit are leading more investors to look into the ABS world as a protective kind of asset class.
Good. So let's move a little bit to the service industry. Our service a blind spot provides a blind spot in your opinion?
I don't think they are in global markets, and this may vary across different asset classes and across different regions. But what we see in terms of the global CLO market is it's a very well-established service provider industry. So you get regular trustee reports on a monthly basis. You have very transparent documentation. If you're investing in the primary market in large size, you often have the ability to negotiate with those managers to tighten up covenants and make sure that guardrails are in line with what you want as an investor. But I think we see broadly the global markets have very good and very tight regulations there. We definitely think that there's probably some areas to be very careful of and make sure you're understanding that documentation or investing in a manager that has that expertise and has that ability to very closely go through some of that. But I don't think that's one of the risks, and certainly in a market that's so large and so well traded, we've had a lot of time to establish some of the processes around here. So, this is a market that's existed pre-financial crisis. It's only grown safer over time. So guardrails have gotten tighter, diversification requirements have improved, the credit enhancement has been improved. So I think this is a very well-established and relatively safe, if I can say that, in the financial industry market, that's had a lot of establishment to get us to this point.
I don't have the same pleasure to to count on the third parties here, or at least I don't have the same benefit for counting this. So here, I think in whole, despite having a very strong credit infrastructure and financial markets in Brazil, I think we're the most regulated, one of the most regulated, and despite of some blind spots that happened recently, but really the whole framework worked quite well. But I'll say that for us, in our perspective, yes, third parties, providers are a huge blind spot in locally. And the way that, again, we frame it is basically when you contract or subcontract a third party in our business, a fiduciary business, you're delegating risk. And if you're not sure about how this guy is managing the risk that you are putting into the portfolio, you maybe end up in a big problem. Probably one of the key drivers in U.S. markets, if you take, for instance, the financial industries, these two employ, I think, 1.2 million, 1.2 trillion employees in the banks nowadays. And asset management as well has a very lean structure. When you're moving this kind of size of market, you're not only moving capital, you're moving the whole credit infrastructure into the asset management. And the way that the market flourished during the last year was less regulation, more speed. And when you combine that with the flows and the pressure to deploy, I think this is a very point to be looked at deeply and assess all the time. Here, the way that we do is basically we want to be the administration, the custodian, the fiduciary, running our systems, having our own legal, having the background. So we are really moving into a more verticalizing in order to have this kind of guardrails, as you mentioned, for our structures. But I would say definitely here in Brazil, making all the third parties suppliers for service and products is a risk that should be monitored quite constantly, undoubtedly.
Okay, so moving for our last question here, and your main takeaways of these conversations. So looking ahead to 2006, what is our outlook for structured credit markets globally and in Brazil, and how should investors position themselves in this environment?
We are very constructive on the securitized markets this year. So if you think about all of the potential investments, and I've had the great pleasure of speaking with a lot of investors here in Brazil that are looking to diversify their overall fixed income book, invest a little bit more offshore. If you look at all of the potential investments, U.S. treasuries are pretty volatile, right? Driven by inflation expectations, the extremely high fiscal deficit that we have in the U.S. There's a lot of volatile aspects there that are really hard to predict. If you look at investment grade credit, which is another one of the big asset classes, spreads are very tight. Technicals don't look great with the additional issuance that's been coming to market. Fundamentals look good. Companies still look in a good spot. We're seeing very good earnings growth and earnings expectations broadly. And there's definitely some opportunity today with the volatility that we've seen, especially within software market. But those are relatively tight markets. So when you're thinking about building a diversified portfolio and looking for those opportunities, where investment grade credit is offering spreads of 80 basis points over the curve, AAA CLOs, so actually moving up in credit quality, can give you 130 over the curve. BBB CLOs can give you over 300 over the curve for assets that are still investment grade rated. And when you think about that comparison with investment grade credit, in the US, there are only 2 companies that are AAA rated. So it is very, very hard to find AAA rated assets. So I think the securitized markets offer some really interesting opportunity there. The other component is CLOs are floating rate in nature. So while most global fixed income is actually fixed rate and is subject to some of these concerns around inflation, repricing, energy prices, given the conflict in Iran, the ability to avoid some of that interest rate sensitivity could be really interesting. So as you're building diversified portfolios, look for some of those areas that can give you some additional spread that only helps cushion in times of volatility, and looking at those asset classes that might be able to insulate you a little bit more from some of that credit risk that we're seeing in software and a lot of the concerns in the market, but also that interest rate sensitivity. So I think Securitize offers a really good opportunity going forward. I think you need to be selective. I think you need to be careful. I think you need to do your due diligence on the asset class that makes sense for you and the investment manager that you work with. But I do think that offers a really good opportunity to increase your overall risk-adjusted return and move on that right way in the efficient frontier and helping to reduce your overall volatility profile, but increase your return potential. So despite all of the volatility, I would say we're very constructive, and I think that's exactly what you want to hear in this time period, right? Someone that's willing to lean into that volatility, take advantage of some of the dislocations, conscious of all of the risks out there, but I think that tends to create good opportunities over the long term.
Very constructive from our side, and for Brazil, I think big shift also making towards the securitization. Again, we are looking all times at look at the U.S. markets and see what you guys developed there, and it's a solid market, and the default rates or the loss given defaults and all those structures are very low. So you're ring fenced all the time with good spreads instead of going directly into the corporate risk. In this way. So yes, a huge prospects here for Brazil. I think the FDIC market now is topping now almost 300 billion BRL, which is huge. And again, the point is that not going for direct to the risk, but having the collateral, having the monitoring on this, it can and you can grant it a good performance over the time. And again, moving into the way that CDI as an asset class in Brazil, and for beating the benchmark, you need to have the exposure to it. I think it's probably one of the best opportunities that's happening when we enter in an easy cycle and you build up a portfolio that can compress against it. So we are very constructive in the market, and we think everything is going to be all right.
Mm-hmm.
Okay, so that's it, guys. Thank you very much for your time. Hope you guys have enjoyed.
Thank you.
Muito obrigada, Grazi, Jéssica e Marcelo.